Investors Chronicle.
Hello, you're listening to the Companies and Markets show from the Investors Chronicle team, bringing you all the news that's fit to broadcast from the listed company universe. A couple of big beasts under discussion today. First up, iron ore and copper miner BHP, fresh from its failed pursuit of Anglo American. It unveiled interim figures the other day, and our commodities expert Alex Hamer is here to look at how the company is now ploughing its own furrow. Then, of course, we can't do this week's show without discussing results put out overnight by AI poster child Nvidia. Alex Newman and Arthur Sants will be on hand to ask whether it's achieved a soft landing of its own. In between, we will discuss our cover story this week on perhaps the only shares that can rival Nvidia for popularity among UK private investors. That is, perhaps surprisingly, the insurers. Alex Newman is going to ask whether this love is justified and give a bit of Insurance 101 for those not familiar with the often complicated workings of the sector. Let's begin with BHP. As is sometimes the case on this show, we have two Alexes on today. Although, Alex Hamer, you, like BHP, are Australian, which should help listeners distinguish you and distinguish who's speaking. The company itself, as I said, is tried to buy Anglo, as most people will know, earlier this year. It didn't pan out. That was very much seen as a copper play. BHP is still predominantly iron ore focused for now. What did the results say, and how did these trends and these assets reflect in the results?
I think it's worth underlining the slight discrepancy between the numbers they've put out and I guess the general vibes around the iron ore market at the moment. The numbers, firstly, were okay. Their underlying cash profits were up 13%, so $18.9 billion US dollars. And the average price they got for iron ore, which is the dominant earner in the company, was $100 a tonne, which is actually up on the year before as well. And I think the context, it's important to note, is that iron ore is down significantly from 2022, 2021. So these are kind of all lower numbers, but historically quite good. And BHP has fairly cheap production in the Pilbara in Australia. So even with prices at $90, they're still doing okay. Their profits won't be world beating, and their margins will come down a little bit. I think for every dollar the iron ore price goes down, they lose millions and millions of EBITDA, but they're still quite comfortable. And I think the other part of your question about, how they're doing with this weaker iron ore environment further out, we will see a bit of a hit to profits. I think the CEO made the interesting point that the iron ore market is a bit more fragmented than we might assume sitting in the UK, where we see what comes from Rio Tinto and BHP. He talked about producers in China and India who are so high cost that when prices are sitting around $80 or $90, they basically go out of production. So he thinks that's a bit of a cushion to the global market, but it still is on a bit of a downtrend. And given the broader environment in China, where there is this move away from real estate as a real driver of the economy, there isn't likely to be a huge pickup anytime soon, which might also partly explain why they're so keen on another metal to drive profits.
We will come to copper shortly, but just to reflect on that China weakness, again, most people are kind of aware of the issues in the Chinese economy, or at least that they exist. BHP has been talking up India on the one hand as a potential offset to that, and it's also put out some long-term forecasts for commodities prices as well. What did we learn from both those things, if anything?
I think it is a little bit aspirational for the moment. I think this started last year when BHP first started talking up India as a really important buyer of iron ore on the seaborne market. India has its own supply, as I just mentioned, but also its economy is quite different to China. I think within the growth that's been seen there, and this is probably best seen in the infrastructure spending by the government across airports, ports, factories of all kinds, railways. There is an increase in demand, but within the context of the steel market being China selling 1 billion tonnes a year, mostly internally, but also sending a lot outside its borders. India won't be a huge proportion of that.
Let's talk about the near term then. The Anglo deal has not happened, or at least not happened for now. As I say, that was seen very much as a way to buy more copper assets with an eye on the future. What is BHP focusing on in its absence? Still copper to an extent, but what's it saying about the next 12, 24 months?
I mean, to go a little bit inside baseball here, the response of analysts on the earnings call this week was interesting, where they asked the BHP CEO, Mike Henry, why there was such a focus on copper when iron ore really does remain their dominant driver of earnings. And he said, please don't think that our marketing is a pure reflection of our interests. What is happening is we're looking at both, and I think the iron ore part of it is that they want to increase Pilbara production from it's about 300 million tonnes a year. At the moment, they want to push that to 330 million tonnes. If you think about the basic fact that they're mining that much every year and then expanding that, it's quite a large undertaking. There are lots of questions from the analysts on how exactly they're going to manage that and how much it will cost. And I think the cost factor is also interesting in these results, because you ask about the shift after the Anglo buyout didn't happen. What they've really talked about here is they're going to increase their capital spending annually over the next few years, pushing it from about $9 billion to $11 billion. And through that, it's almost a pivot to organic growth is the way they're framing it, with the added plea to think of it as something they would have done anyway. But I think the shift there is spending on iron ore. Then also they have a range of options on copper. They own the biggest copper mine in the world, Escondida. They're the operator and just about majority owner of that, with about 51%. And while it's not one of the century-old mines that are also still very important in the industry, it came into production a few decades ago, and they're actually getting to the lower grade, harder ore, and that grade will drop off a fair bit from 2027. So that the capital intensity of a mine like that is going to start increasing. So they basically have to keep spending more to produce the same amount of copper. There's a few really big ticket items that they're thinking about. So a new concentrator plant at Escondida, and there's smaller operations that could also boost their copper output. They just put out a resource for a kind of sub BHP size deposit in South Australia, which is near the Olympic Dam mine. They've bought into this Filo mining in Argentina, split on the Argentina-Peru border, alongside a company called Lundin. It's kind of piecemeal. I think they're not adding huge copper reserves and copper output through a mega deal like the Anglo proposition, but they're saying we can actually increase our copper production just by spending a little bit more every year instead of that big whack of an acquisition. Their preference has obviously been to do that acquisition, but it was a deal that didn't seem very close to happening, despite the Anglo board actually engaging with BHP. Because if we think about the structure they were proposing, they basically said to Anglo, rip yourself apart, solve all these issues for us, and take this small premium, which, I think we said at the time, it was a kind of wild proposition for Anglo and its shareholders, even if BHP does have quite good prospects and a portfolio that has been much more successful over the past few years. It wasn't a great offering for the Anglo shareholders.
Perhaps they were just trying their luck, thinking as well through the prism of what would look like as a company that tried to do this but didn't. A lot of investors might be quite relaxed about it not happening. I think I'm thinking too conspiratorially here, but it's interesting to consider their thinking before and after. But yes, you're also right. Of course, as you and they point out, iron ore is still about 2/3 of underlying earnings, so still the dominant chunk, and it definitely seems for now like that copper increase will be iterative, if anything. Let's wrap up quickly on this section by looking at the valuation. How does it look now relative to history, relative to peers? What's your take?
A really boring answer. It's about It's about right.
Yeah.
I mean, a company like this, you look at EBITDA as a behemoth in the world of mining, slightly above its 5-year average. Sorry if I didn't have anything spicy there.
The market is up with events. It's fully efficient in this case. All right, well, it is what it is. Sometimes that is going to be the case. Let's move on to the cover story, as I say, this week in print. Of course, it's available online as well. Alex Newman bringing you in now. We're talking about insurers who, as I say, are some figures you obtained from Hargreaves Lansdown. Maybe not surprisingly popular because we know that those dividend yields in particular always attract people, but the extent of the popularity was quite interesting. Can we talk about that first of all and then talk about the context for the piece as well?
Yeah, so I mean, we know at the IC how popular these companies are because we always see a spike in the traffic whenever we write a result for an M&G or an LNG or an Aviva or even a Phoenix. Despite their relative size within the FTSE 100, these aren't enormous players. I think you have to head down to near enough the halfway mark within the FTSE to get to the likes of LNG and Aviva. But LNG and Aviva in that order were 2 and 3 after Lloyd's in Hargreaves Lansdown's list of the top 10 net bought UK shares within Stocks and Shares ISAs on their platform over the last 10 years. So obviously relative to their size and weight within the index, they are, they're really punching above their weight. And as sort of listeners who may have listened to the podcast we do with John Lee will know that he's one of those huge fans. He likes M&G, LNG, and Phoenix for their dividends. He likes that because that sort of recycles cash within his portfolio, gives him options. So yeah, they're really popular among a retail investor base. You probably could contrast that with their popularity among equity fund managers who may take a slightly more reticent approach to the sector. I think they do, and that probably accounts for why their yields are so high, because they are actually fairly lowly valued in some regards.
Yeah. The follow-on question really is, not wanting to treat people like they don't know what they're doing, but do we think all investors actually know what these companies are doing? Because they can be very complex beasts in some cases, which is what we try to elucidate and enlighten. Maybe people looking to buy into the sector for the first time, attracted by those yields. What we try and do in the piece is explain exactly what they do and what some of these terms and mysterious terminology mean.
Yeah, a split answer. I mean, I'd say I think broadly people do know what they're doing. I think if you see a 9-10% yield, you know that there is a risk reward trade off here. I don't think most retail investors are just blindly going to the top of the dividend yield tables and saying, "Oh, I'll have a bit of Phoenix, thank you. There's nothing that can go wrong here."
Sure.
If you look at their track record, you will also not fail to notice that these are high beta stocks in some cases. There was one analyst I saw, they plotted against the kind of credit spreads within European corporate bonds. So in other words, whenever there's a very high volatility event and spreads blow out, or there's a big shift in interest rate assumptions, it can be quite volatile rides for shareholders in these companies. You can get sharp sell-offs. We saw that in the September 2022 gilts crisis. And yes, there are, within life insurers particularly, lots of moving parts. They're heavily exposed to long-term fixed income instruments, and they are often liquidity concerns or concerns around buffers when we have major economic events which upends the assumptions of actuaries. So do people know what they're getting when they're buying these stocks? I think a 9% yield tells you a lot within the facts of its being. Do all UK investors understand the inner mechanics of life insurers? Again, there are lots of moving parts. There might be some areas where people want things explaining, or that's at least one of the questions we had, which kind of prompted this piece.
Yeah, absolutely. And there is a lot in there. As I say, we won't go through every case by case basis on the podcast, but written down, there's a lot of information there and the nuts and bolts. It can boil down to, though, as you say in the piece, in cases of the big insurers, and two distinct aspects. The obvious one being, in order to succeed, they have to write policies profitably. The less obvious one being they also have to make good investments effectively. as well. Can we talk a little bit about those twin requirements?
Yeah, so I mean, in the piece, I sort of almost sidestep the question of the life insurers, because in some ways there are more straightforward ways to explain the insurance business model than an LNG or an Aviva. So looking at a company like Beazley, which we do in the piece, which some people would refer to as a kind of classic property and casualty or P&C insurer, but for practical purposes, they're a specialist, so they write policies to do with, say, cybersecurity, professional indemnity insurance, or sort of more classic property insurance in areas where coverage may be light from some of the bigger insurers. And yeah, the first way to measure a company like this is the profitability of this activity of insurance underwriting. In simplified terms, it sort of boils down to one equation, which investors or listeners may have heard of, the combined ratio. So this is the sum or the combination of the two costs, claims paid and underwriting expenses, divided by the net written premiums, and insurers refer to net written premiums as opposed to gross written premiums because they cede a portion of the premiums they write to reinsurers to help spread their risk. So in short, it's kind of operating profitability ratio. And in the case of Beazley, lately they've really been in the sweet spot of being able to grow their business, write more premiums, because they're in some areas where there's a real growth in demand for risk coverage, at the same time as doing that work very profitably. So they've got big margins and they're growing the business. So, there's a lot of operating leverage in the business. But the thing which you also refer to there, which makes insurers unique and which kind of should mean that they are, throughout the cycle, quite stable businesses, although that doesn't always play out in reality. It also explains why Warren Buffett is such a big fan of this sector, is that they have effectively a negative cost of capital. So, and Warren Buffett calls this the float. What it means is that they technically get paid to provide a product, the risk coverage, because premiums are collected before claims are made. They get paid up front, and so they are free to do what they want with the cash before they have to provide the product. So, that differs obviously to a widget maker, which has to spend all this money on a factory up front to make the widget and then sell it and hopefully make a profit, or a bank, which commits lots of capital to making a loan up front and ideally will profit at a later date from the interest it earns. So insurers immediately invest collected premiums, yes, with one eye on keeping coverage buffers high in the event of lots of claims, but also to grow shareholder equity and the balance sheet. Again, Beazley, to stay with the example we look at in the piece, they've been pretty solid at doing that. It's not hugely interesting kind of investing. It's not that spicy because they have rules which kind of limit how spicy they can be with their investing. It's a lot of corporate and government bonds, but the compounding effect of that investing activity on top of their operational or insurance writing growth, it almost creates kind of a twin engine to the investment case. And that's why in the case of some of the specialist insurers and some of the US insurers we look at in the piece, they're performing very strongly and they've got a really good opportunity to grow their book value or shareholder equity in the years ahead, even if interest rates and the availability of cheap investment returns does decline a little bit from levels we've seen.
To an extent, I suppose we have to take, perhaps even more so than other sectors, other companies, we have to take all these things as articles of faith, these things being the assumptions made about writing policies, the investments they're making. You have to accept some macro risk there, as you say, but and also in the case of life insurance, the longevity assumptions, because these are certainly in the latter case actuarial calculations. It's not easy for outsiders to work out or ascertain exactly A, how they're doing it, and B, whether they'll prove to be accurate. So even if you understand all these things, there is still an element of faith involved with these businesses.
Totally. And to return to the black box nature of, the life insurers, that is equally, if not more so true in some regards for, a P&C insurer or, slightly more esoteric specialist insurer, because, you're having to place your faith in their underwriting ability. You don't have access to the very complex meteorological models they're basing their risks, their risk assessments off in order to write hurricane insurance, for example. So yeah, you have to make peace with that, I think, as an investor. But what I suppose we can rely on a little bit is that, one, we do live in an age of risk, which is characterised by this sort of unrelenting drive to put a financial price on uncertainty. So there is a growth driver there. So demand, particularly in the areas that specialist insurers are sort of swimming in, there is a demand there. But second, you can refer to the track record of underwriters as as a sign of their ability to price risk effectively and profitably. And it's not going to work out every year, and that's the nature of insurance because they're dealing with huge uncertainties. But past performance in this instance has to be taken as a bit of a guide to future results because you don't have as much information as you do when it comes to, say, understanding the brand strength of a retailer, for example. It's a totally different proposition.
Yeah. One other interesting part of the piece, among several, was the different way to value these companies, inspired, I think, by Polar Capital, was it? There's interesting metrics in there that you look at.
Yeah, so I spoke to the Global Insurance Fund team at Polar Capital. So it's one of the one of the few funds globally which invest specifically in the insurance sector, and they've done really, really well. They've got a sort of 25-year track record. Both the principal fund managers come from the insurance world, and they've got a very close understanding of of all the players, all the underwriters in Lloyd's, Bermuda, and the US. And one way they measure things, rather than just looking at multiples in terms of the price earnings, because there's quite a high degree of volatility in and an inability to predict claims as they fall due. They look at I think what they term as the cash on cash yield. So it's in a similar way to the price earnings growth multiple, in that you're looking at the rate of growth in book value per share relative to the current price to book value. I mean, if it's a bit complicated, maybe it's a little easier to reread in the piece and the way we spell out some of those multiples, and provide some data and a table on how some of the insurers stack up on that metric. But thinking about book value, thinking about the residual shareholder equity can be a useful way to think about the margin of safety, again, as term Warren Buffett and his antecedents like to talk about, that you have within insurers if things go really, really pear-shaped, which occasionally they do. But actually, this is a much more stable sector than it's sometimes given credit for.
Yeah. The thing that struck me while we were talking about this reminder was not to totally override everything we've just spoken about, but the sometimes the impact of those dividend yields as well for an investor can be quite significant. Both you and our colleague Julian have written about M&G in recent months or recent years, and just you look at the share price chart, as a lot of people drag it up on Google, it looks very uninspiring. You add in the 10% dividend, as was, probably still is, and the return's been incredibly strong. So I think this is a prime example. Again, not to just buy in on the basis of that, but of the returns that can be made if you make the right choice and if those dividends do prove sustainable.
No, definitely. In the last 3 years, I think Aviva, M&G have defied the skepticism around their share prices, and there are underlying growths in the business. I think we've talked about in the past the kind of bulk purchase annuity market has been an actual driver of profits. But yeah, I mean, dividends don't just pay out; they can compound as well.
Yeah, indeed. Well, if this has got you interested, or you want to know a bit more, or just work out what those metrics actually are and what they look like, do pick up a copy of the magazine or have a look online. You can now get 12 weeks of an Investors Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. We are going to conclude with Nvidia, the erstwhile biggest company in the world. It's still right up there, certainly at the top of that Hargreaves-Lansdown list, I think, Alex, which is notable in itself, given it's going back over a decade.
Yeah.
And yet Nvidia, for many investors, will only have been on the radar the last couple of years. It reported interim results last night. These things are really observed very closely nowadays. I believe there was even an Nvidia results party, which got some mild traction on social media. Arthur, I know you are in New York. I don't think you're at the party, but what did you make of the figures themselves? It seems to be a case of meeting and maybe surpassing, in some cases, very high expectations, but such is the weight of those expectations now that they didn't quite surpass them enough for some people, as strange as that sounds.
There was a one-person party while I was writing up the results for the website last night. I guess in some ways none of it was that surprising. I think people thought that they beat expectations, revenue more than doubled. I think all of the hyperscalers had already reported in the last month, and their capex spend was ahead of expectations, and they make up around half of Nvidia's revenue. So I guess everyone knew that the results were going to be pretty remarkable, and they were, in the sense that revenue more than doubled for a company whose market cap is $3 trillion. But the share price went down because the expectations are ridiculously high for the business now. And even though it beat their consensus expectations, I guess there's sort of shadow expectations that sit behind those that were even higher. So the market was expecting more. Some of the issue came from production problems with their newest chip, which is called Blackwell. And there were rumors that there were issues going into the results. They said it was to do with the mask, which I've learned is basically like the stencil that sits on top of the wafer, which the lasers then use to etch onto the wafer. And that was supposed to go into production this quarter that has just passed, which then, and instead it's now been pushed out to the fourth quarter. So that would have been the reason for the results being a little bit below what the market expected. But analysts seem pretty confident that that problem was now in the rear view mirror. And Jensen Huang said that the CEO said that their ramp would come in the fourth quarter, and that would start generating billions in revenue. So in general, I think people, all things considered, given the valuation and its importance to the market, it's gone all right. I guess a bullet was slightly dodged. I guess there's more fear around it now than there is expectation, which might say something in itself.
I know you've been writing for a while over the last couple of years about how coming to the valuation here, on a simple price earnings basis, it looks expensive, but the earnings upgrades are enough to justify that growth. A couple of months ago, you started saying, well, actually, they may be no longer the case. Is that still what you think now, insofar as there's only so far those upgrades can go, as we've just alluded to? So therefore, given that, and given maybe the concern about the company's prospects at the margin, in short, the valuation no longer has that much room to give.
Yeah, I think so. So at the beginning of the year, I think it was trading in the 20s in terms of its forward PE, which is when we tipped them again. And that went quite well. And then in the summer, because that was being driven by the earnings upgrades, but then during the first 6 months of this year, the share price growth was massively outpacing the earnings upgrades. So the PE multiple stretched out into the 40s, which to me, and then I think it was the end of June, maybe July, I then said that it felt like these valuations had become pretty stretched, which so far seems to be the case. And I maintain that view partly because just in terms of like the law of large numbers, for a company that size, it was going to be tricky for it to keep growing at 200%, and growth is now coming back down. It's still expected to grow at 70% annually, or 79% annually next quarter, which is pretty impressive for a company that size, but growth is just going to start slowing. The other thing that I thought was interesting on the same day was actually the results from Salesforce, which reported on the same day as Nvidia to less fanfare. But Salesforce is still a huge software company. Its revenue growth has slowed down to, I think it was 8 or 9% last quarter. It's been promoting these AI agents it wants to introduce into its product, which its CEO Mark Benioff, who's always a bit sort of enthusiastic, was really pushing on the call, I guess, to try and drum up some enthusiasm around a company that's seeing its growth slow. But the thing that I thought was interesting was that these AI agents will be billed on consumption rather than as a subscription, which is very different to how software has usually been billed. Usually your company, if it's enterprise software, will pay a subscription fee upfront depending on the number of people in the company that will be using that product, and then the people can use that product as much as they want. Whereas with these AI agents, the more the people use the product, the more the company would have to pay. So if someone with the Salesforce is marketing software, so someone's using that agent a bunch in the marketing department, then the bill will rack up, which I thought was interesting because the problem with AI, or one of the problems, is that actually it's much lower margin than traditional software because of the inferencing costs. So every time someone has to use an AI product, it has to go through these models, which is expensive. And the fact that they're going to bill on consumption, I think shows that they're worried about how much lower gross margin these AI products might be than traditional software. Because if they then build on subscription, they might say, oh, well, you pay us upfront annual fee, and then suddenly Salesforce customer starts using their AI agents a bunch, and then actually they start losing money because they're having to pay loads of computing costs to run these models. Salesforce's results, I thought, are sort of a little window into the next stage of this story, which is that we need to start seeing the software companies use AI to generate genuinely productivity enhancing products for their customers, and the customers demanding the products and paying a lot of money for them. And so far we haven't seen that. I'm not saying it won't come, but maybe the timeline will be a little longer than we expect, or there'll have to be some shift in how expensive these models are to run. I know that there's sort of, if you write more efficient code and stuff, then it can become more efficient, but we'll see.
Yeah, indeed. In some ways, it seems like things are coming full circle if you have a software as a service company starting to then work by volume rather than subscription, which maybe leads us just to wrap up to, if I can bring you back in, Alex Newman, on the question of the market maybe in some ways moving on from Nvidia, if such a thing could be deemed possible. It's interesting maybe to think, I think you put it earlier today to me, maybe Nvidia is achieving a soft landing here, i.e. being able to produce results which just about meet expectations, but maybe also lessen the emphasis on Nvidia in future. It's interesting in a way. We've had a lot of US data come out just as we're on air right now, very much supporting the economic soft landing argument. We've had better than expected, I think, GDP, lower than expected core inflation, decent unemployment figures, all of which means I think the NASDAQ is due to open up. Nvidia is going to be down 2 or 3%. So it's in some ways in this halcyon best of all worlds I'm describing, it's no longer required to drive the market on. I wondered if that's the kind of thing you were thinking about looking at these results.
Yeah, I suppose at the very least, I do hope, this might be the beginning of a change in the market narrative, because, the colossal interest in Nvidia's story is totally understandable, and all the options trading and hedge fund carry trades we've read about, of course, have repercussions and matter for the market. But I suppose the idea that this fairly esoteric company, as big as it is, helps explain the entire direction of the sector, let alone the market, has become a little bit overdone. Because I think even within the Magnificent Seven, which holds so much sway in the movement of the S&P and global trackers, there's clearly, and we've talked about this a lot on the podcast, there's clearly a divergence of fortunes within those companies. And then second, it's not quite a zero-sum game, but as we've talked about the capex spending of Nvidia's biggest clients, that powers Nvidia's earnings momentum, and it has done. So if that falls off, or if they turn down their projections for AI, or at some point it gets moved in-house, that doesn't mean that everyone loses. It might mean that there's actually more cash on hand for big tech, which is sort of rolling back some of the AI fever. So, theoretically, that might mean it's more of a headwind for Nvidia, but then maybe theoretically we'll be able to see things a little bit more holistically, and not just that the market is controlled by one outlier company, which seemed to be the narrative in the run-up to this. So hopefully that bubble's popped at least.
Indeed, or deflated in a nice, calm way. I think it was in the Unhedged, the FT newsletter this morning, talking about market leadership over the last few months, and it is the interest rate sensitive sectors like utilities, staples, etc., which have started to lead again. So perhaps we're seeing a broadening out in general But there's no doubt tech will continue to occupy the forefront of most investors' minds for a while longer, I think it's fair to say. Anyway, that does bring us to the end of today's show. We have run out of time. Thank you very much to both Alexes and to Arthur and to our producer, Maddie Apthorpe. Thank you to you for listening. We will not be back next week. We are having a week off, but we'll be back in a fortnight with another Companies and Markets show.